Well, stocks have posted their biggest two-week climb since March of 2009, and confidence among individual investors has soared right along with that move. The Bloomberg chart of the day illustrates that, according to the American Association of Individual Investors, the proportion of respondents who are bullish has risen to almost 44%. And Jim Paulsen, chief investment strategist at Wells Capital Management, says the real story may not just be bullishness, but volatility. During his career, he's been named top economic forecaster by Businessweek and top interest rate forecaster of the year by Bond Week. Jim is joining us now from Minneapolis with his take on what's going on in terms of sentiment here. And of course, you always have some volatility in these sentiment indicators. But when you talk about volatility, what kind of measures are you looking at?
Well, if you look at that index, you know, we came a couple weeks back. The bullishness level in that index, Julie, was as low as it was since the bottom of the market in '09. Now, a couple weeks later, it's one of the highest readings since '09. Back in July, it was close to one of the lowest readings again. So it's been extremely volatile. And I guess what I think that reflects more than anything is sort of kind of a unique debate that investors are struggling with here today that we don't always in the past. At this point in the cycle, 1 year into recovery or so in the past, we'd be debating whether this recovery is going to grow at 3% or 1.5%. And there's a little bit of that debate going on today. But I think the bigger debate in investors' minds is, are we going to grow at 3 or are we going to have a depression? And that's a debate we haven't really had in recent decades that makes your sentiment shift wildly depending on what reports come out. You can imagine in March and April when the S&P was running up to 1225 and the 10-year Treasury was blowing through 4% and sentiment was really bullish. Within a few months, we went from there to the S&P falling to almost 1,000 and the 10-year Treasury going below 3%. The difference is we were on the one hand sort of discounting a 3% recovery and then started to discount a depression. And that unique stance today could leave not only sentiment but markets, both interest rates and stock prices, extremely volatile here for the next year or so.
Well, and I assume then that would make these kinds of bullishness and bearishness indicators less useful to an investor. As you know, of course, there are some investors who say when things are more bullish, I'm going to get more bearish, and vice versa. But if they're swinging so wildly, I mean, can you do anything with that?
Well, there's probably still some information content there, and still, if you look back, you know, we've been the lowest levels of readings at sometimes at market opportunities, and when it's been high, maybe there's a near-term sell-off period. But I agree. I think because of the special nature of the volatility of these markets, that these bullish and bearish sentiment indicators aren't as useful as they used to be in the past.
Now, Jim, while I've got you here, I have to ask you about the president's comments, not just today in his press conference, but throughout the past week or so as he steps up rhetoric on the economy. As an investor, what do you think of the strategy at this point and its effect on the markets?
Well, I'm less concerned about what the president is discussing for a couple reasons. One is I don't think they're going to get much done between now and the election anyway. They can talk a lot of rhetoric, but little action. And secondly, Julie, I guess I'm more tuned into where I think the real policy official is, and that's not the Federal Reserve and it's not the executive branch. Laissez-faire markets have given us a good easing policy here in the last several months. They've dropped the 10-year Treasury from 4 to 260. They've dropped mortgage rates from 5.5 to 4.5. They've taken oil prices from $90 last spring to the mid-70s. They've dropped the value of the dollar. The Chinese officials have stopped tightening. That's the stuff that I think as an investor that's important to me because it tells me that there's a good chance that the economy is likely to pick up by the fourth quarter, irregardless of what the president or the Federal Reserve does here. So,
Jim, just quickly here, what are you doing with your money as a result?
I think it's a great time to look at risk and to buy there. The future is not going to be on fear. I think we've been through that for the last few years. The future is going to be on confidence. And the biggest opportunity for investors right now is to invest today on the idea that we're going to have a slow and steady rise in confidence in this economy and also in the markets. And that lends you more towards the more economically sensitive sectors. The technology, I think that's getting beat up so bad, consumer discretionary stocks, markets, emerging markets, all fit that bill. I think they're going to continue to gain fund flows, if you will, as confidence slow but surely improves.
All right, Jim, well, we'll have to check back in with you and find out if you're right and if the confidence starts to pick back up again. Jim Paulsen, thanks a lot for joining us. Appreciate it.
Thank you.